pull up a chair, because what I'm about to show you might save you from a very expensive mistake. Every recession, you hear the same advice. Just move your money into safe investments. But are they actually safe? So I did something simple. I took $1,000 and split it across 5 so-called safe places: a high-yield savings account, dividend ETFs, gold, blue-chip stocks, and just holding cash. And what happened next wasn't what I expected. I've seen this before. I know how this story usually ends. Some of these safe choices quietly lose you money, while one of them does a much better job protecting your wealth. Let's break it down. When things get scary, people don't run away from the market, they run toward what feels safe. And I get it. Losing money hurts. But the problem is, it's not really safety they're getting. It's comfort. Let's start simple. High-yield savings accounts. On paper, they look perfect. Your money's safe, you earn a little interest, no surprises. But that's not quite the full picture. You feel like you're earning, but inflation is quietly taking more than you're gaining. So yes, your balance goes up, but your buying power goes down. And that's where people lose without realizing it. Safe, but shrinking. Next, dividend ETFs. These are interesting. You're getting paid regularly. It feels steady, predictable. And over time, compounding does work. But the upside is limited. Think of it like planting seeds. They grow slowly, reliably, but when the market runs, they don't keep up. And during recovery, that matters more than people think. Now, here's where things get interesting. Gold and silver, the classic safe haven. You've probably heard it. When things go bad, gold goes up. But in this test, it didn't behave that way. Gold has history, no doubt, but history doesn't always repeat the way we expect. Sometimes it lags. Sometimes it just sits there. And in this case, it underperformed. Now let's talk about something people think is safe, but isn't. Blue chip stocks. Big companies, strong names. They'll be fine, people say. And they will be, eventually. But during a recession, they fall too. And this is where people make the biggest mistake. They panic, they sell at the bottom, and they miss the recovery. I've done it myself, years ago, and it cost me more than I'd like to admit. That's the real danger, not the drop, the timing. So here's the insight. Safe doesn't mean what you think it means. It's not about avoiding losses completely, because that's impossible. It's about what happens after the loss. Which brings us to the final piece. Cash. Just sitting there, doing nothing. Feels safe, right? No drops, no stress. But here's the problem. While you're sitting still, the world isn't. Markets recover, opportunities move, prices rise, and you're left watching from the sidelines. That cost is invisible, but it's very real. So when I compared everything side by side, the safest options weren't what people expected. Some protected money, but quietly lost value. Others dropped, but recovered stronger. And that's the lesson. Safety isn't about hiding, it's about resilience, about choosing investments that can bend without breaking and recover with time. Because in the end, patience pays. So, next time someone tells you to play it safe, ask them what they really mean. Because now you know it's not that simple. And if you want to understand what actually builds wealth during times like these, watch this next video. We'll take it one step further. Slowly, properly, the way it should be done.